Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Let's go over the green shoots. So, you know the worries, Monday, Tuesday, into the Wednesday sell-off, and then Wednesday, and then Thursday, it's not done, and then Friday, green shoots. And then I waited, and I did that pre-market saying that I saw green shoots, and then I waited until the end of the day to kind of overview what I saw as coming in. Monday starts the Santa rally, and it was kind of slow to get going, but picked up speed a little bit on Tuesday. But Friday was productive. Friday was productive, green shoots. Bullish outlier that I pointed out was this one, massive candle, which was just the market telling me they were hell-bent on going higher. And they have. You know what SPX has closed yesterday, just under 6,000 again. And then, of course, the fact that it is Santa, and that's pretty powerful. Last 5 trading days of the year, plus the first 2 of the new year. And then, of course, I still saw semis as getting up to go, and they did. So that was a nice little timing for the Nvidia long. But it is also indicative of coming problems. So the green shoots that we're having right now, perfectly, for example, SVXY, which is inverse VIX, loosely defined, had 3 levels of weekly support, and it reversed very strongly. This is from a Friday image, right? After market close, where now I expect it to head back into this area. So that's bullish the market. The XM spiking higher in no print in a soggy tape was also bullish the market. And then, of course, you've got the Santa rally on top of this, which was a waterfall cascade in value getting crushed right into some kind of critical kind of 30-week support levels. So you did have a lot of reason for the market to move higher, but we needed to see it. Started to see green shoots on Friday morning, did talk about it, and then wrote about it just to kind of, if you have to manage on your own while you're traveling, or if I have to have the room closed, for example, like on Tuesday, and the market's closed, you'll know my thinking. My thinking was, I think we see the lows for December on that Friday, especially if BXM was an indication and SVXY was an indication, and then this bearish but on watch for reversal higher outlier of NYSE, cumulative flow, etc. So I think that was pretty much guardrails, so you weren't shorting into the whole Friday morning. If nothing else, it protected you from shorting into the whole Friday morning. So anyway, long story short, this is what I was warning about. Very, very firm above inversion after this breakout pullback. It looked very much like it wanted to scoot higher. That's a daily. This is also the same exact thing. Yields, if you recall, were defended right before the Fed on September 18th, double cut with a 50 basis point rate cut. And this is what happened since in this yield curve. And now this is what we have right now. Ta-da! All right, so this did exactly what I expected, which was to break out higher. And that means the 10-year bond fell, the 10-year yield, and pretty much everything but the 3-month yield moved sharply higher, including the 30-year, which means there are shorts. Every time the 30-year moves higher, your correlated play, if I have shown you this since all year, all bloody year, is to short anything related to refinancing, right? The rocket mortgage, the home builders, that kind of stuff. So as 30-year moves higher, the correlated plays are inversely just shortable. So this is still pushing. So this is why I'm looking at this 10-year this morning going, okay, nothing wrong with that. That breakout is extremely firm. Right, there's that 16th, by the way, when we hit at 3.6, got back above 3.8. This is very key, 4.37. 4.5 was the same as we had basically before the yen carry trade unwind, before yields and oil fell and concentration risk was unwound. Anyway, this is the opposite. We're moving higher. We kind of came back, got the energy, and pushed above that very key level of 4.37 and then 4.5. So now it wouldn't surprise me if we get a little bit more. Let's just call it, we hope we get a little bit more. It may not happen, of a shallow pullback here. But big picture, I've got this huge level of 4.6, we'll call it 4.69, where if we get above 4.69 on a monthly, now we're not there yet, we're not done the month yet, it's a big honkin' headwind because we're going to be moving more quickly, higher. But for right now, usually the way that this stuff works is we tease around it. So kind of like up here, right? We made it all the way back up to my 4.37 and then teased above it for a few weeks, dropped below it, grabbed all those who had this very, 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 very bullish bond view. And I'm like, no, no. And in fact, when did I do my December 12th was, but I was talking about this, right? This is like, we're going higher right here. Be careful of a yield spike. And then boom. So yields went higher and bonds dumped exactly when they were getting extremely excited with all kinds of narratives that they make up. Doesn't matter, but this worked. So I think we're going to potentially have the same type of exercise up here. When we get up to that 4.69, we can trap some bears and bulls alike. Remember what happened here? We had a solid pullback before we had the energy to shoot higher. This is actually a monthly level, so it's kind of key. So we'll have to see how that plays out, but it is playing out. It's just basically it in a nutshell. All right, moving along. Holy smokes, right? All right, so Friday morning I saw, well, Monday, Tuesday I said careful, SPX and Qs are gonna catch down. Oh gosh, did they? Right back 1 month worth, 1 month worth, very impressive. Thursday not done, and then Friday I saw green shoots. So here's your resulting. We had a little pullback here on Monday, and then Tuesday we definitely got a little active here with a push, and here we are, wait, almost back to gap down. So we'll be looking for this to be real or not. And so here's what I mean by real or not. So you can see right now in my MAG 7 ratio, which has obviously been holding up the market, we have still continuation. There's no pattern here, and this is on a weekly. There's no pattern of reversal yet. There's a pattern of strong breakout from December 2nd. What else happened on December 2nd? My growth to value rotation ratio went boom on December 2nd, and FANG stocks have been lit up and value has been crushed. There will be some opportunities in the new year around XLE, XME, that kind of stuff. But for right now, I'm just saying this is still in play. So we had that first week, second, third week was a little shake and bake, but not really anything to upset the apple cart, literally. And then green already into this kind of Thursday morning print. So we're still in play. There's no reversal. But let's talk about what's real. Remember this? How this was falling over? This was the US Japanese 30-year spread. And I'm like, yeah, this is like definitely not looking good. And at the same time, the Qs are moving higher. And then we had the big dump. Boom. And SPY and Q collapsed. SPY went down finally 3%. I mean, that's real. And I took away, in fact, the comparison with Qs and SPY overlay because they were too busy on this 2-hour chart. You can see where we bounced. Here's your Friday morning, right? Green shoots, little Monday, little Tuesday. But look at this thing. This is nowhere near what SPY and Qs are doing. So I trust this more. I think we have a reflexive bounce. We got a lot of thin liquidity out there. We got a lot of retail. Big books are gone, by the way. Bye-bye. They're not trading in this slop. They're on vacation. So gold is still a mess, nothing, no direction. Dollar yen is a worry now because we're melting up into instability. I'm not going to worry so much about high yield spreads right now. I've already posted about that. I see that as a late January effect. But for right now, you can see dollar yield ratio is extremely elevated above 300, and the market just continues to ignore high dollar and high yields, and everyone's trying to normalize it. But speaking of real versus fake, okay, so remember that head and shoulders? And I said, be careful if we pierce this 120, there's going to be selling in SPY, and we had this 3% day. Boom. Then we had a convexity bounce. Pretty typical, right? That was the August 5th. But it wasn't as productive, honestly, because look at this, 3 green days, but this puppy is still pointing lower. So that's also a little fake. They're not so in. But MAG 7 is still camouflaging the weakness underneath the surface. Here's SPX not falling apart. If you want to trigger, then you know it's really this kind of 6,000 area. Otherwise, we're heading back up to 60.53 and we'll probably keep going. But it's on the backs of these guys. And so they might take a little vacation after this year. Eyes on this prize. Falling US bonds, falling yen. That's going to matter. And this guy, this spread differential is very much weak. So even though you can, hopefully you can see this, but this is actually SPX in the Qs. So you can see, and then this is inverse VIX. But the point is they are a fractal together. You can see how strong Qs have been, SPY has been, inverse VIX has been. But this differential says, prove it to me. Nowhere near where it sold off. So this is still a warning sign that the market is just not as healthy as it appears, especially not with a screaming higher dollar yen. and not with this guy. And this is starting to get pushed back at that 1.2 level. So in the short term, I wouldn't be surprised if Friday sees a little shake and bake.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.